you here today to the Tax Trends webinar. We're going to have the pleasure of learning more about U.S. reporting requirements for foreign assets. Just a little bit about myself. I'm Jared Johnson. I'm part of Eide Bailey's National Tax Office. My role on the team is I'm the director of Global Mobility Services. The Global Mobility team, what we do is we help companies who have a global workforce, which we help them establish processes to work more efficiently in moving these employees across borders. And we also help the company and the individual with personal income tax compliance issues, payroll issues, and other advisory issues in both the home and the host countries. The Global Mobility team, we also help one-off individuals who may be moving cross borders, and we help them with their tax compliance services, as well as in both the home and host countries. We also help a lot of individuals navigate through these complex issues around foreign asset reporting and help them be in compliance there. And we also help them when they're not in compliance and have delinquent international informational reporting that needs to be corrected. We really do quite a bit around this area, a lot of expertise, which I'm really looking forward to talking more about today. We're going to talk today about the following items. This is what we should be able to accomplish. There's a lot of information in this in such a small amount of time to cover all this. So we're going to be discussing a lot of these items on a very high level in order to accomplish all of today's objectives. I'm happy to take any conversations, one-off conversations offline with any of you to discuss any of these things further in which we aren't able to cover today. So first, we're going to discuss each of the most common international informational reporting forms and the related IRS regulations. We're going to talk a little bit about the penalties associated with those for failure to file. We'll review the U.S. the FBARs. We're going to talk a little bit about reporting of ownership in foreign corporations and foreign partnerships. We will then talk about what are your obligations as an owner or beneficiary of a foreign trust. We'll also then tackle the fun conversation around PFIX, and then talk a bit about how to analyze and determine filing obligations around ownership of a foreign pension. All right, so next slide. These are the common international informational disclosure forms that are out there. A list of them. As you can see, from this slide, there are some of the many U.S. international information reporting forms which U.S. persons are required to file for the U.S. government. A lot of people wonder why the U.S. would require so many different international informational returns or reports and information. The U.S. government requires these forms for a variety of reasons. One is to fight financial crimes such as money laundering, tax evasion, and also to combat support of terrorism. And so as a result, you'll see a very significant civil penalties and sometimes criminal penalties associated with a failure to file these forms, which we'll go over next. The items that are bolded on this form, we are going to talk more about in this presentation. So the top one, the most common, is the FBAR. We will address that. The next one below it is its sister form, the FBAR sister form, which is the Form 8938, and we'll talk a little bit about the differences between those two forms. We'll then, the 3520 and 3520As are both reported in relationship of foreign trusts and also receipt of certain foreign gifts. The Form 8865 and 5471 is ownership of foreign corporations and foreign partnerships. And Form 5472 is also pretty common, but we won't address this one today, but it's an information return where a U.S. corporation that's owned 25%, 25% foreign-owned U.S. corporation, or where a foreign corporation is performing U.S. trades or businesses. 8858s are information returns around foreign disregarded entities, and 8621s are the forms which we'll discuss later today about PFICs. So this next slide is really around the penalties around these forms. This is why these forms are such a big deal, is because of these penalties. As discussed earlier, each of these forms carry with them these significant civil penalties and sometimes criminal penalties. As you can see, the FBAR, if you're non-willful, it's a $10,000 penalty per each non-willful failure to file. If you're willful in your failure to file, the penalty could increase to be the greater of $100,000 or 50% of the account balance. And then there's obviously criminal penalties and sanctions which couldn't be applied to these. This is really a big deal, and I want to point out on this is per violation or per account, not per form. So if you have several forms that or several bank accounts in a foreign country that did not get reported, each one of those accounts could be penalized and assessed these penalties. So very draconian type penalties. 8938, again, it's up to a $10,000 penalty. You'll notice a common theme with most of these of being a $10,000 penalty. There are continued failure to file penalties with the Form 8938 up to a maximum of $60,000. The Forms 3520 and 3520A, it's the greater of a $10,000 or a percentage of corpus of what's being held, and that U.S. person's portion that's held within the trust. And on the 3520A, there's potential criminal penalties with that one. The other forms and their related penalties is the next slide. Forms 8865, again, $10,000 up to $100,000 depending on facts and circumstances. And the same with 5471s. Of all these, the ones I really see the most of that are coming through are the 50 penalties around. I see a lot of these in our practice, and maybe it's just because there's more. It seems like there's more foreign corporations than there are foreign partnerships, but I see a lot of the 54 delinquent penalties for 5471s and 5472s. There's also the 8858 penalty, which we sometimes see. The outlier of all these forms that we've talked about so far at Form 8621, which is the PFIC form, again, we'll talk more about what PFIC is and what that is. But there's no civil penalties for failure to file this form. Really, the failure to file this form results in an unlimited statute of limitations. Just like if you didn't file a normal tax return, there's no statute of limitations on that return. Failure to file PFIC does open up the return for the same issue is if you have a PFIC and you didn't report it on Form 8621, you should have, then there's no statute of limitations. Okay, we're going to dive right in then to these different forms. So FinCEN Form 114 is the actual form name of the FBAR reporting. So FBAR is an acronym for Foreign Bank Account Reporting, and that's the buzzword that most people know it by. But the actual form is called FinCEN Form 114. So a little bit of history about the FBAR. The most common, this is obviously the most common informational return or form that's out there. I talk to people regarding the FBAR on a daily basis, in which many questions come up during these discussions. And many times it's asked, how many years has the FBAR filing been around? And there are a lot of people are very surprised when I tell them the FBAR filing had its origin with the Bank Secrecy Act of 1970. So it's been around for a really, really long time. Now, has everyone been aware of it and filing for that long? No. It's kind of gone under the radar for a really long time. It really started picking up momentum and more people being aware of it because of the large civil penalties, which began in 2004 as part of the Job Creation Act, the Job Creation Act of 2004. Some of the more common compliance changes of filing FBAR is that the form is now required to be e-filed. I do still get a lot of people that will ask me, well, can I just paper file this? No, you can't. You have to file it under, I think the website, it's like bsa.org or I think that's the website that you register through if you don't have a software that's already registered to file through it. Obviously the filing threshold for this, and we'll talk a little bit about this a little bit more, is when you have foreign bank accounts that exceed $10,000 in aggregate during the calendar year, you have a filing obligation. FBARs are now due. This is a change as of about a year or two ago. They're now due April 15th, which is more in line with the individual returns and a lot of the different other returns that are out there. There's an automatic extension of time to file it, so you don't have to file an actual extension form. You get an automatic 6-month extension out to October 15th of each year to get these e-filed. So next, we're going to talk a little bit more about the details of the FBAR. Who must file? I'm going to read a definition here, and then we're going to kind of break that down throughout this slide of what this means. So who must file an FBAR? A U.S. person that has a financial interest in or signature authority over foreign financial accounts must file an FBAR if the aggregate value of the foreign financial accounts exceed $10,000 at any time during the calendar year. So a lot of words: U.S. person, financial interest, signature authority, foreign financial accounts, aggregate. What does all that mean? So first off, what does aggregate mean? So if you have 2 foreign bank accounts and they each have, let's say they each have $8,000 in them, then the filing obligation is you have to report both of those foreign bank accounts on your FBAR, on your FinCEN Form 114. So even though neither one of them exceeded $10,000, it looks at the value in aggregate of all your foreign bank accounts. What is a foreign financial account? Foreign financial accounts include, but are not limited to, securities, brokerage accounts, savings accounts, demands accounts, checking accounts, deposit accounts, or other maintained accounts. It also includes commodities, insurance, and insurance policies with cash value accounts. So not just insurance premiums or annuity premiums, they have to have the cash value accounts tied to them. And that cash value account is what gets reported. It also includes mutual funds, and could also include pension accounts, foreign pension accounts. Any of these types of accounts physically held or maintained by banks or branches of banks physically outside the US, and that are maintained by banks or branches of banks or foreign financial institutions of any sort. And if they're physically outside the US, then those are those are foreign financial institutions or that are required to be, accounts with those foreign financial institutions need to be reported. What does it mean to have a foreign financial interest? So when a U.S. person is the owner of record or holder of a legal title, that's regardless if the account is for the benefit of someone else or the U.S. person. If they have if they're the owner on record or they hold the legal title, then they have the financial interest in it. So I like to think of this as like a parent that may be holding an account for a child. They hold the title of it sometimes, and even though it's for the benefit of that individual, they would be the one with the financial interest in it, not the child. This can also mean that a U.S. person has legal ownership and financial interest of assets held by entities, such as corps, partnerships, trusts, or other entities. So ownership typically occurs when the U.S. person owns more than 50% of direct or indirect shares of stock. So if you're an owner of a foreign corporation that has foreign bank accounts and you own more than 50% and you're a U.S. person, you would have a financial interest in those accounts. What does it mean to have signature authority? So kind of that same example, if you're an owner of a corporation, but you own less than 50%, but you're listed as a someone that has signature authority over those accounts, you still have an FBAR filing obligation. So signature authority is the authority of an individual alone or in conjunction with another individual to control the dispositions of assets held in a foreign financial account. So by direct communication or in writing or some other form. So that's really what a signature authority is. So you would have an FBAR filing obligation if you have signature authority or financial interest in the account. Who are U.S. persons? So this includes citizens of the U.S., green card holders. So these on the individual level. It also includes U.S. tax residents under IRC 7701B. The way the 7701B is the explanation of the substantial presence test. So it's a 3-year look back rule. If you're in the U.S. for more than 31 days in the current year, and you have more than 183 days in the prior 3 years, and the test is on that 183-day test is you look at 100% of your current year days, a third of the days in the U.S. in the year before that, and then a sixth of your U.S. days in the year before that. If the sum of those add up to 100% or 183 days or more, then you are a resident of the U.S. and would have an FBAR filing obligation. I'll point out one other thing. If you meet that residency rule under 7701B or substantial presence test, but you make yourself a non-resident under a treaty position, then you still have an FBAR filing obligation in those situations. There are exceptions to filing an FBAR, and I'm not going to go into a lot of detail on what these exceptions are. I'd like to point out that there are several of them. I lean on the side of caution when it comes to this because of the substantial penalties and the fact that this is just information in nature and there's not tax tied to these, tax due tied to reporting to your foreign accounts. I lean on the side of caution. So if there's any question whether or not something should be reported, I usually report it. Some of the exceptions are certain jointly owned bank accounts. Sometimes one spouse needs to report it, but not the other in certain circumstances. They're filed separate than each other. So unlike a US 1040 return where you file a joint return if you're married, under an FBAR you file each one separate than the other unless you meet this joint situation. Owners or beneficiaries of U.S. IRAs and U.S. qualified retirement accounts are an exception. Can be an exception, I should say. Consolidated FBARs for consolidated corporations could be one. Qualifying individuals who have signature authority but no financial interest could be one. So there's a long list of them. Under the FBAR, what's filed? It's the maximum balance of the account that gets reported. You basically need to get periodic statements during the year, and you figure out what is the maximum balance of those accounts. You report the bank name, the address, the account number. It's pretty limited information. That it's significant information that gets put down, but it's not very much in volume that's required. So I'm not going to talk a lot about 8938s, but I will tell you the difference between the two forms since they're sister forms. So the 8938s are filed with the individual or filed with the return. The FBARs are filed to the Department of Treasury, separate than the actual tax return. Some corporations, domestic corporations, may need to file 8938s if you're a specified domestic entity, and a specified domestic entity is defined as a closely held domestic corp or partnership where at least 50% of your gross income or is passive, or 50% of your assets produce passive income. Then that entity would need to file an 8938.
The question that I had is it okay to report estimated amounts?
I would say, I get this question quite a bit because sometimes it's really hard to track down accounts, especially if you're filing delinquent years and accounts have been closed or something. I like to say the only time I do this is if it's absolutely necessary, and I would err on the side of caution of over-reporting the balance in there, of having a very conservative estimate rather than a non-conservative, because if you're ever questioned, you'd have to substantiate that value that you used with the IRS or the Department of Treasury. So hopefully that answered your question, or answered the question. So the filing thresholds for the 8938 are much higher than the FBAR filing thresholds. So it's very common to have an FBAR filing obligation, but not an 8938, unless you have a significant amount of assets, because the threshold for an 8938 is dependent on your marital status or filing status on your return, if it's an individual return, and whether or not you're living inside or outside the US. And just to give you an example, the filing threshold for an 8938 for someone who's unmarried and living in the US is the total value of specified foreign financial assets is more than $50,000 on the last day of the year, or more than $75,000 at any time during the year. Now, if you're unmarried and you're living outside the US, these amounts get much higher, and you would only have to report it or file the form if your total value of specified foreign financial assets are more than $200,000 at the last day of the year, or more than $300,000 at any time during the year. So you can really see that this this filing threshold is much higher than the FBAR, and sometimes you have an obligation to report one but not the other. The other difference is signature authority accounts don't need to be reported on 8938 because you don't have a financial interest in them. Now, if you have financial interest because of your ownership percentage in a company, then yes, I'd report them on the FBAR as well, or on the 8938 as well. Types of assets reported on 8938, there's a difference, and one of the main differences is, or an example of one of the differences, interest in a foreign entity is reported on 8938, or like the value of a stock that you hold in a foreign entity would be reported on 8938, not on an FBAR. So there's some other differences there as well. This leads us to the first polling question, which is, when was the FBAR reporting first implemented in the U.S.? A, with the implementation of Jobs Creation Act of 2004, with the implementation of Bank Secrecy Act of 1970, or C, none of the above. So really, with the world becoming smaller, there's more and more of these foreign financial assets out there. This should always be addressed with your accountant around compliance season. Because of the nature of these penalties are so significant, make sure you're having these conversations with them. The majority answered that correct, which is it was with the Bank Secrecy Act of 1970. The penalties started being implemented with the Job Creations Act of 2004. So let's go ahead and close out. Let's move on. Thank you for participating in that. So we're going to talk a little bit about Form 5471 now. This is around the ownership of foreign corporations. So reporting, not all ownership of foreign corporations need to be reported, but anyway, so really the purpose of this form is to comply with IRC Code Sections 6038 and 6046 for certain foreign corporations. It's also there to create and establish a position of ownership in foreign corporations with the IRS, so they now have record of you filing and your ownership of that foreign corp. Before tax reform, foreign corporations were used a lot to defer income until the money was repatriated back to the U.S. Now, post-tax reform, this form is used to determine taxable income that needs to be taxed each year, either through subpart F income or guilty income or one of these other new ways that the income is going to now flow through on an annual basis. Form 5471 is filed with each taxpayer's annual return, and so it's due on the date of each of those returns. It doesn't have its own separate filing obligation or separate filing date. So how do you know who must file? Generally, you must file if you fit into one of the 5 categories as defined by the IRS. And so each of the 5 categories, so category 1 is a U.S. shareholder of a foreign corp that is IRC 965, defined under that section as a specified foreign corp at any time during the tax year of the foreign corp. A specified foreign corp is a CFC, which you can get a definition of under category 5, or any foreign corp which one or more of the domestic corp is a U.S. shareholder. So we'll talk a little bit about that in just a minute. Category 2, 2, 3, 4, and 5 are more, they've been around a lot longer. So category 2 is if you're a U.S. person that's an officer or director of a foreign corporation in which any other U.S. shareholder has acquired stock which meets the 10% ownership or 10% voting within the company. So if you are a shareholder or officer and another individual in the company that's a U.S. person acquires enough stock to have 10% of total ownership or 10% ownership of voting shares, then you're a category 2 filer. And what gets lost is you don't have to file that every year, only in the years in which there was a category 2 transaction type thing. Category 3 is the same thing, is you file it in the year in which a U.S. person actually acquires or disposes of enough stock during the year to get them above the 10% ownership, or if they sold enough to get them below the 10% ownership level. Then you file it only for that year in which that transaction happened. And that one is if you are the U.S. person either acquiring or having the disposition of stock. Category 2, it's if you're an officer or director and that happened during the year. Categories 4 and is a U.S. person who had control of a foreign corporation during the year. So control, and I'm going to point out that U.S. person is defined the same as an FBAR. Citizen, green card holder, or basically a domestic corporation, partnership, or trust or state. So control is defined more than 50% of total combined voting power, or more than 50% of total stock value across all classes of stock. And then category 5 is a U.S. person who owns 10% or more of a foreign corporation, which is classified as a CFC. A CFC is a controlled foreign corporation. And that is when a controlled foreign corporation is when a foreign corporation that has U.S. shareholders that own more than 50% of total combined voting stock, or all classes of stock. So if U.S. persons own more than 50%, that corporation is a CFC. And if you own more than 10% of stock of that CFC, then you have a category 5 filing obligation. So those are kind of like when you have it, it's very confusing. We can help you understand if you have a filing obligation in those situations. It's not very intuitive. The IRS has not made it very easy, believe it or not. What's happened with tax reform? I'd say that this is the thing that has changed the most within tax reform. Category 1 is new with tax reform. Before, it was a repealed category. There's a lot of revisions to the schedules. I think before tax reform, the 5471 was, it more than doubled in size and the number of forms and schedules you need to complete now. If you depend on which category of filer you are. And so with tax reform, we get all these cool acronyms that we with each of the forms. So FDII is what I like to call it. So foreign derived intangible income. This is a new concept with tax reform. This is a preferential tax rate that some may qualify for if a domestic C Corp has qualified foreign derived intangible income. The IRS is specific on what is qualified income, so we can help you determine what is considered qualified foreign derived intangible income on that. But you can kind of see the preferential rates here on if you meet these requirements.
We got a question here. I got one. Form 5471 Schedule P is ridiculous, correct?
that is correct. There's a lot of schedules within the form that are ridiculous, and I really, what I want you to understand, and when you're filing a 5471, you're not. I get this a lot with clients around fees, because it's really around fees. I mean, these are not. They were never easy before tax reform, especially now after tax reform. You're filing a corporate return. And not only are you filing a corporate return, but you're trying to take rules in a foreign country from financial statements and how they derive those foreign, trying to convert them under US GAAP and putting them on a US tax return. It's not easy. And a lot of these forms are not easy. A lot of the concepts are not easy. And needless to say, Schedule P.
I got one other question here.
Yeah.
If you have a small CFC, let us say makes $1,000 per year, what has to be done and what should be done in the past, like pay tax on accumulated E and P?
Well, I would say that if you meet the filing obligations of categories 1, 2, 3, 4, 5, then you should be filing 5471 regardless of the amount of income. If that's a problem and you're seeing no more benefit of having the foreign corporation because of the amount of income, then I'd say dissolve the foreign corporation. But I wouldn't run afoul with these penalties that are out there, because they're very significant. And yes, there's a cost of having a business. You're going to have to file a return if you have a very small and you know, and insignificant, even if the EMPs are insignificant. So the earnings and profit, the accumulated earnings and profits that need to be paid and repatriate back to the U.S., that was in 2017 under the Section 965. That all should have been done in 17. Now going forward, we're subject to GILTI income, which now takes us to these taxes are now, you couldn't, before you used to be able to defer the income and repatriate it when you wanted to back to the US and get taxed on it at that time. Now the US wants it up front, and through GILTI, you can kind of see that that's the case. And you can kind of see through this slide, under the old laws, you know, what the tax implications are under and what they are under the new rules and laws. What I would say here is that pass-through entities will be double taxed without restructuring. So another option would be to restructure your entities. And there are different elections, and I'm not going to get into all the details of those here because we just don't have enough time. We're already running out of time, and I still have quite a bit to do. But I would highly recommend that if you have a 5471, there are options out there that we can help you in restructuring, and maybe we want to treat it as a flow-through entity. Maybe we want to keep it as a CFC. And so let's, you know, but these are around, this tax is around CFCs, not under categories 2 and 3. So let's go on. Form 8865, we're just going to plow through this because we're running out of time, and I have quite a bit of information left yet to cover. So 8865, the purpose of the form is just really to be compliant with the IRC sections 6038 and 6046. This form is also attached with the taxpayer's return each year, and so it's due on the deadline of the taxpayer's return. There's categories 1, 2, 3, and 4. 4 is really this determines whether or not you have a filing obligation. Categories 4 is really under if you have a reportable event under 6046A. So if you have acquisitions, dispositions, or changes in proportionate interest. Category 1 is if you are the U.S. person who controls a foreign corp. Category 2 is if you own 10% or greater interest in the foreign partnership. And so if there's a category 1 filer, there will be no category 2 filers. That's kind of confusing, but if you think through that logically, then it makes sense. Category 3 is if you have, during the year, you contributed property to a foreign partnership, and through that contribution, you obtained a 10% or more interest in that foreign partnership. Or if the value of the contribution exceeded $100,000, then you have a category 3 filing obligation. The foreign partnerships, I'm just going to, categories 1 and 2, you're generating K1s that then flow through to the shareholder or the partner's personal returns or tax returns, I should say, because it may not be an individual. One last comment I'll put here is that you can still claim IRC around tax reform changes. You can claim IRC 199A deductions with these foreign partnerships. Let's go on. So let's talk a little bit about 3520 and 3520A. Oh, polling question first. Was Form 5471 and reporting ownership of foreign corporations impacted by tax reform? Yes or no? I'll just say again, or I'll reemphasize that there's some tax planning around foreign corporations. So make sure that you reach out. We're happy to help you and sit down with you and talk to you, see if that makes any sense. The answer to this obviously is yes. It was impacted significantly, and that was the majority that they answered. So we will move on to 3520 and 3520As. So this is around reporting of foreign corporate or foreign trusts, I should say. We're first going to talk about, so 3520 and 3520A, this is kind of could be a long discussion. A U.S. person, we've kind of already gone over what they are. A 3520 is a standalone return. So it's filed on its own. It's the 3520 is filed on the 15th day of the 4th month of the person's tax year. It is not like if you're an individual and you have a foreign trust, it's not filed with your return. It's filed separate. Who must file the return? So a person who transfers property to a related foreign trust. A U.S. person, you are when you're treated as the owner of a foreign trust, and a U.S. person who receives a distribution from a trust. There's also another part is if you receive more than $100,000 from a non-resident alien, individual or estate as a gift, or if you receive more than $16,076 from a foreign corp or foreign partnership as a gift, then you have to fill in a section of the 3520 only. The rest of the form is pertain only to foreign trusts. So the purpose of this form is it's an annual return for the foreign trust with at least one owner. And this form provides information as to U.S. beneficiary or U.S. owners. They must prepare and include on their U.S. return under U.S. grantor trust rules. So what is a grantor trust? It's a foreign grantor trust is a trust that's where the grantor owns all of the assets or has substantial control over the assets. And that would be a grantor trust for that owner of the asset. He would be the grantor of it. And then the foreign trust is when a court in a foreign country can exercise primary jurisdiction over the trust and not a U.S. court. And so a foreign trust with the U.S. owner must file 3520A. The U.S. owner is responsible to ensure that the foreign trust files the 3520A, and if the foreign trust fails to file it, then the U.S. owner must file a substitute 3520A and attach it to the form 3520. So it's on the owner to make sure that it gets done, and if they don't do it, then they file the substitute themselves. And again, the 3520A is also a standalone document, which is filed on the 15th day of the 3rd month. And both the foreign trust owner statement and the foreign trust beneficiary statements generated with the 3520A get filed to the beneficiaries and the owners accordingly by that 15th day of the 3rd month. So March 15th for individuals and, whatnot. So pretty fun stuff with the 3520A. Let's talk about PFICs now. So what I'd like to do, and we're going to gloss over, but what is a PFIC filing obligation, and what are the different PFIC tax regimes that are out there. So this is the definition of a PFIC. So you have the income test, 75% or more of the income is passive, or there's the asset test is the average percent of the assets held is 50% or more. This will tell you what this test is used to determine what a PFIC is. Now some rules of what is a PFIC that we generally see, common examples of them. Foreign corporations used for foreign investments. So foreign corps that generate, or foreign entities, I should say, that generate passive income could be a PFIC. Partnerships invested in PFICs, we see this a lot on investments in publicly traded partnerships. A lot of times they're heavily invested in PFICs. Mutual funds or unit trusts. So if you have a Fidelity account that's invested in foreign assets here in the US, not really a PFIC, but if you go up and you open up a Fidelity account, a brokerage account in foreign country, and they're invested in mutual funds or unit trusts, you have PFIC issues. Non-self-managed Australian superannuations. Superannuations is an Australian form of like a 401k or foreign pension. They could be considered, they would be a self-managed fund could have PFICs in them if they're invested in hedge funds and mutual funds. And there's other types of things that could be. So again, depending on what the underlying assets are in some of these investments, like retirement plans or life insurance policies, or so these are things that we can help you kind of go through and determine. What is who must file an 8621? Here's a list of 8621s. If you are a direct or indirect shareholder of a PFIC, and they meet one of the following one of these filings, like if you're making an election, or you receive a distribution from a PFIC, or recognizing a gain, or you're selling or something like that, then you're going to have a PFIC filing obligation, which is done on Form 8621. The different tax regimes, there's 3 of them. The default method is the excess distribution method, which is under IRC section 1291. Really, why the US cares what a PFIC is what happens is people will dump investments in foreign mutual or in a foreign brokerage account or maybe like a PFIC, and they will basically, what will happen is the income earned from those accounts will get reinvested and they never get distributed. So you're deferring income, and so under the excess distribution, the IRS is penalizing you for that, not bringing those monies back. So when you do have an income component from those, then you get nailed with tax on them at the highest marginal rate with interest over the holding period, and it could be very detrimental if you've held them for years. It could be very draconian. So mark-to-market and QEF or QEF, Qualified Electing Fund, are elections you can make, but you can only make them in the years in which you start the PFIC. You can't make a late election. And so they are ways you can tax them on an ongoing basis, which we could help you determine whether or not you qualify to make one of these elections. There's a lot that kind of goes into that, which one you can elect, but in most cases it is beneficial, but sometimes it is beneficial just to remain in the default method, which is the excess distribution method. So polling question number 3, what is the default PFIC tax regime? Excess distribution method, mark-to-market method, or qualifying electing fund method? A, B, or C? And that is correct. Excess distribution is the default PFIC tax regime. So, can reinvested income from foreign trust earned by a U.S. person be subject to U.S. tax, or subject to tax on U.S. tax return? And there's a typo on this one, and I'm gonna. Can the reinvested income from a foreign pension earned by a U.S. person be subject to tax on U.S. tax return? And the question is yes or no. Yes, that is absolutely correct. And income, and I think this gets oversighted a lot, is what about income from a foreign trust, or keep saying foreign trust because we talked about foreign trust, foreign pensions.
And also
foreign pensions are qualified in the foreign country, but just because it's qualified in that foreign country doesn't mean the U.S. recognizes the same qualified. It would be qualified for U.S. tax purposes. So a lot of times that income could be subject to tax.
And from my end, I got everybody written down that was
Okay.
and that they didn't get it. And I'll mute myself and give it back over to you, Jared.
Okay, awesome. Thank you, Sean. So I'm just going to go back and we'll make this kind of brief. We've talked about we're on the PFIC tax regimes, the 3 different PFIC tax regimes. There are opportunities to kind of plan here if you're moving. What's really good is if you have these in the very first year, and let's talk about what method you should file under. And in certain company situations, if you're the direct shareholder, you can make an election under the QEF or the mark-to-market election for other shareholders, indirect shareholders. So what is that like? Do you want to do that for all your shareholders, or do you want to leave the election up to them? So those are things that you should consider when you have PFIC investments. What we like to look at, and the last polling question was around this. What I like to look at when I'm dealing with foreign pensions, and again, these get oversighted because they're qualified in foreign countries. So when you have an individual that has, they have a pension in a foreign country, a lot of times they don't want to think or even think about it because nothing happens to them in that other country with it. They don't have to do anything with it. Well, here in the U.S., if you're a U.S. person, you might. And it depends on if it's a government pension or a private pension. If it's a government pension, and I use this as like an example of U.S. Social Security. You're depositing funds in a U.S. Social Security. You're turning your money over to the U.S. government, and they tell you whether or not you have a benefit coming to you at the end. Because you lose control over those assets, you have no filing obligation, only in the year in which you start pulling out distributions. And I'm just going to say a lot with pensions, you have to look at when taxation or how they're taxed or how they're reported. You also have to look at tax treaties. What does the tax treaty with US and UK say about the income earned from a pension during the life of the pension? And what does the treaty say about when you start pulling out distributions from the pension when you're a resident of the UK or a resident of the US? The treaty will usually tell you which country has a right to tax that. And so there's a lot of analysis that should go into this, both before you become a retirement age and after you become a retirement age and you start pulling out distributions. They should all, these types of things should be addressed and looked into. But the reason, so if it's a private pension, I then start looking, well, is it a defined benefit plan? A defined benefit plan is like the old retirement plans that are out there. A lot of companies would contribute money for you, and then they promise you a return at the end of the year, or when you retire, every year after you retire. A lot of times those funds are no longer yours, that are held in those accounts. And so sometimes there's not a reporting obligation to report them on an FBAR 8938 because you don't own or control the asset. You just have a policy that says you're going to get $1,000 a month when you retire. If it's a defined contribution plan, that's more like a 401k in the foreign country. Then we start looking at who has control over those funds in that. Is it the individual or is it the company? What can you do with it? And that will determine whether or not it could be determined as a foreign trust or an employee trust. And whether or not you have to include income. Let's say that the company's making a contribution to that fund every year for you. Do you have to include those contributions into your income every year? You might. It's likely you may. Do you have to report the growth from those foreign pensions into your income on your U.S. return? You may have to, depending on what kind of of a file, is it employee trust or foreign trust, would depend on, you know, whether or not you have to report the income from those. So a lot of time that's determined because companies don't want to determine whether or not they're qualified or not. It takes a lot of money and for someone to study a company's retirement plan. Let's say that an individual moves to the U.S. and they worked for X company and now they're a U.S. person. Well, it doesn't make sense to go and study that foreign employer's retirement plan to determine if it's qualified for U.S. retirement purposes. So if you're not going to do that qualified study or and document it, then a lot of times you got to make a decision on how those are going to be treated. So that's really in a nutshell what we look at with foreign pensions. There's a lot that goes into it. If there's any discussions out there, I'd be happy to sit down with someone to discuss it. Okay, thank you everyone. Have a good rest of your day and have a great weekend.